Welcome to CFO Insight TV. There's some good news. The UK has recently emerged from recession. But as economic policies and banking regulations are still being drafted, there's still a lot of uncertainty shrouding the outlook. Today, we welcome to the studio Mark Spofforth. He's the president of the ICAEW, the Global Accountants Association, to discuss some of these issues. So, welcome to the studio, Mark.
Hi.
Let's begin with banking, maybe. Right now, there's a proposal on the table to ring-fence retail banks from investment banks. Of course, it's going to make the banking system, supposedly it's going to make the banking system safer, but it's also going to drive up borrowing costs and maybe even the cost of hedging. What can be done, do you think, to dampen the effect on company CFOs?
Well, I think it's inevitable it's going to happen. You know, part of the trouble with the banking system has been a mixture of the traders and the professionals within the bank. So the traders come into work every day looking for a quick profit. The professionals are there to look after the companies, look after CFOs long-term, build long-term relationships. So the culture is very different. And I think it's really important that this split does happen. Interestingly, though, there's not just one idea on the table. I made a speech back in 2009 saying that I thought the principle was right. Well, since then, we've had 2 or 3 different ideas about how that might be done in practice. And I think it'll be interesting to see which one prevails. I suspect the European model might be the one that comes over best. And it's a case of splitting the risk management, the capital allocation, and just making sure that we don't have an institution that is too big to fail, but is taking enormous risks. So I think the moral situation where you've got banks that are too big to fail has got to stop. Now, that is inevitably, it's going to drive up costs, because in the past there has been some investment banking work that's been very profitable, and it's enabled free banking for individual domestic customers, let alone reducing the cost for businesses. So we're going to see an increase, but at the same time, those CFOs who are putting together the best package, the best information, should be able to drive down the costs for their individual business.
So you're saying an increase in costs is okay, it's inevitable to happen, it should happen, but CFOs will be able to cope with it?
They should get a better detail of the cost, and therefore they should be able to work out how they can best reduce the cost in individual circumstances.
How important will alternative sources of funding be for CFOs to fill any gaps in funding they may face from banks?
Really important. I mean, it's already happening at the bottom end of the market. In my day job, I'm a practicing accountant dealing with the SME sector. And already in that sector, people are not going to the banks anymore. They're looking to family and friends. They're looking to business angels. They're trying to find anywhere where they can match funding with their needs. And with interest rates being so low, there's quite a few individuals out there who are looking to lend. You've got crowdfunding going on the internet, all sorts of ways. And part of the difficulty is that these people actually don't trust the banks very much anymore. And it's not a trust of they're going to lose money. It's a trust of not being able to put forward a proposal that they believe is going to be accepted. So what we've been doing at the ICAEW is trying to work with banks and businesses to put together a template to make sure that at the very least businesses are giving the banks all the information they need to be able to make a rational lending decision. But they have a problem. They have a problem in trying to build up their balance sheets at the same time as actually wanting to lend. So my understanding is at the moment the banks have quite a lot of liquidity, a lot of cash to lend, but they are using it to shore up the capital and shore up the balance sheets. So I think it's going to be some time before confidence comes back, because the moment the banks can quite easily turn around and say there's not the demand there because the businesses are not going to the banks. You know, we have something like £725 billion of cash on the FTSE balance sheets at the moment. That money ought to be out in the market with some confidence, driving business forward. And we've got to find some way of unlocking that.
Let's take a look now at the business environment in the UK. There's recently been some news that some companies are considering relocating to the UK because they say the tax environment has become more friendly. Is that an observation you share?
No, not really. I say that because our tax code is still the longest code in the world, and because there's still a certain amount of uncertainty. Has there been change? Yeah, there has. I think the government is working in the right way to try and reduce the uncertainty and to make sure that everybody knows where they stand and that there's going to be consistency in the long term. And that's what's attractive to business. It's not what the system looks like now, but it's knowing what it's going to be like in 5 years and 10 years. I was recently talking to a senior person at the Lloyd's insurance market, and they're trying to get capital in from all the way around the world, And it's a very attractive business because it's in a regulatory environment that is understood, it's trusted, and they know that in the short to medium term, they know pretty much where they're going to be. I don't think it's as much about tax rates as about trying to simplify the tax complexity.
When we talked a while back about the UK economy, you said you made a very strong case for exporters for the need for companies to boost their exports. Have they made any progress since then, and what do they need to do to get there?
Well, we've been working a lot with UKTI to try and improve the exports that are happening. And yes, in recent months, I think in the last 4 or 5 months, exports have gone up by about 3.5%. That's good. That's progress. It's not nearly enough or nearly quickly enough. So there need to be some good incentives for certainly people in the SME sector, certainly the middle-sized and larger businesses who are not exporting, to start to look outside. But I think, as I explained last time, this is about a culture of wanting to go and find a market that is prepared to buy your goods. And I really do believe when you go abroad, you find the demand is there. It's a case of matching the people over here who want to sell with the people abroad who want to buy. And if we can help in any way in doing that, we're going to ease the movement to market to be able to export and to sell into a growing economy. Our economy is not going to grow anytime soon, not at any reasonable rate. If companies want to grow faster than that, they're going to have to find other markets.
We're already getting to the end of our interview, and I'm now going to ask you 3 questions, and I would like you to answer with yes or no if possible, please. Do you see the risk of another UK recession next year?
No. I think it's going to be flat, maybe ups and downs, but no.
Will the attractiveness of the UK to businesses increase?
Yes, absolutely. And that's about trust, really important, trust and regulatory framework.
And do you think the impending banking reforms will hurt the London banking industry?
No, London has a particular place in the world. It's on the right time zone. It has trust. I think they will win out, whatever happens.
Thank you, Mark. That was Mark Spofforth of the ICAEW, and thank you for watching.